Ladies and gentlemen of the crypto space, we're live on a Thursday, September 28th at 4:12 p.m. When? Real soon. What's going to happen? Some shit's going to go down. Uh, isn't it obvious? Gensler was on his testimony yesterday on the Hill. He's getting a lot of pressure. I don't think that's overwhelmingly significant. I think most of that narrative about what's going on with regard to approval slash regulatory approval is about choosing which products have a particular classification. So the reason I diminish the significance of that narrative is because I don't need someone else to tell me what's significant. I know what's significant. I know based on inspection of a balance sheet if an enterprise is actually healthy. Is it reasonable? Is it profitable now? Is it likely to be profitable in the future? I do not need someone else to tell me that shit. I don't need a regulator to tell me what a good investment is. I don't need protections. I am my own protector. So I don't really buy into that being the most important narrative in play. Particularly, the reality is that if liquidity conditions were favorable for growth, expansion, financing of, ventures, and that's what venture capital does, then enterprise would be they would try to build enterprise, which is the explosion we saw in 2020. And obviously, with an excess flood of liquidity, you see an explosion of shit. You see malinvestment. So, what the regulators from a federal central bank perspective try and do is manage the liquidity conditions such that there's not an excess of liquidity nor an inadequate supply of liquidity. Excess liquidity, cheap credit fosters malinvestment. You just get cash and you throw it wherever the hell you can find a place to throw it. It doesn't matter because everything is going up and cash is plentiful. And obviously, the prevailing conditions currently are that there is a significant lack of liquidity. And that lack of liquidity is, isolated because we inspect from the global perspective as cross-border capital does quite well. The liquidity's there. The liquidity has come down, which probably imparts fear and restraint and restricted interest in deploying capital, particularly considering uncertainties that are literally screaming at us from a technical perspective. Oh, I don't have my green screen. It's late in the afternoon and I'm so unprepared. I figured I'd get something out for you guys. Let's fix this real quick. Stream. Hello. I'm missing an edge. Which edge is it? Am I really that far off? This is not the time to be doing shit like this. But all right. Hi, guys. So, you know the deal. I look at macro to tell me where the liquidity conditions are because that is what is going to indicate to me when enterprise is going to potentially receive capital. Not necessarily from a consumption standpoint, but also from an OPEX standpoint. So they could actually build products and services that are useful for the real economy. So our focus predominantly is crypto markets, and that's part of the financial economy. But for the first time in its entire history, dating back to Bitcoin, it has overtones of useful services to the real economy vis-a-vis credit systems. Being that the real economy is completely dependent on credit systems, not in the perverted sense in which our macro financial construct has found itself, but that is what drives an economy, the capacity to get credit to try a business. Otherwise, you just have incumbents. You just have people and enterprise that already have money doing the new business. But the real greatness of a society comes when a person that does not have money, that has a great idea, is able to gain access to capital to try a business. So credit is the lifeblood of a functioning, successful, growing economy. So you don't have to really take our perverted state of global financials in a bad way, or that credit itself is bad. The problem, well, we won't get into the problem. Obviously, the problem is there. We see that now at a sovereign level. So we're looking at the DXY here, and between tomorrow and Monday, it's a pretty interesting couple of days coming up. Particularly of a day and 3 hours, end of day tomorrow, to see where the DXY closes on the monthly. Now, there's no moving averages above head at all. There's nothing. Sky's the limit. And this is a precarious situation because we'll flip over to USDJPY in a second, the Japanese yen. Now, if this doesn't close, where was the price that I was saying about 105, 130, give or take, below the monthly TWAP, time weighted average price, it's a breakout. And then clearly you can have a rejection of the breakout. And in that regard, we have all of October to see if it gets rejected. But if we see resistance hold at a nice wick above the time weighted average price, that is at least comforting for October. And we're not that much sitting on the edge of our seat waiting for October to complete to see if we have an invalidation, maybe a bearish engulfing to the downside. Who knows what's going to play out? But this is quite precarious. Stoke RSI is completely reset to the downside. So for me, my eyes are on this chart. I'm very interested in the close tomorrow. Japanese yen is just wild, and that's obviously driving the DXY. The yen is just, there's nothing good to say that's coming out of Japan right now. They are unable to get control over their currency and debt market. And look at this. If this breaches, Q4 22 highs, there's nothing. There's nothing in sight. And look at this. Look where we are. We're back in like 1990. And if you breach that, you're talking about 85, 86, 87. Now, if you go over to the DXY and you look at 85, 86, 87, right about here, 85, and this was the Plaza Accord back in 85, where countries got together and said, yeah, there's not enough dollars, and the FX markets are going to completely implode, and the only currency left standing is going to be the dollar, which means every other currency fails. There's no supply chains, and the entire global economy gets completely turned upside down. So we're pretty much there from an FX perspective. When? Right now. Right now. So folks always say crash when, and they're going to see something. It's occurring right now. All these phenomena are like celestial events. The shit takes time to play out. It's not just hours. It's days. It's weeks. It's months. Which is why nowadays I just look at these damn monthly candles, because anything else will drive you insane. Very much look forward to October. With regard to data, if we get a confirmation of a breakout and time-weighted average price flips to support, that's precarious. So what does that do from a capital management perspective for a person such as myself? Time. That just means it's going to take more time for the complexities to figure themselves out, to figure out what's going on and how long it's going to take and which country is going to have to intervene first. And frankly, it's probably all of them. The bond market is basically screaming that something is broken with a 47.81% of a retrace on TLT from March 2020 highs, and this is a crash by any standard. And we haven't seen a crash like this. You're literally going back definitely pre-flip in the 80s towards the decreasing interest rate environment. And folks are probably thinking about the 40s. And I'm no historian in that regard. That would probably be best suited for like a Lynn Alden to most correlate what's going on right now to historic, the most reasonable historic time period. But to me, this screams, change, big change. And that's exactly what's going on when you hear Gensler talking to Congress like he was yesterday. This big change, they don't have answers, and that means there's also opportunity. So there's two sides to the coin. When everyone's scrambling to figure out what the fuck's going on, I find that quite comforting to have the clarity that I do to peer through the bullshit. I don't need someone else to tell me what a good investment is. I know what a good investment is, and that's not dependent on external factors. Now, there's a big difference between a good investment actually working out, because that could be dependent on external factors, but I know a quality product when I see it, a quality credit product, a quality Eurodollar system that is currently available in incarnations that have never been historically available. So that's an innovative enterprise. That's not dependent on like a sovereign checkmark regulator approval. These systems do what they do. So this is the time when things are changing. I'm excited. I'm excited to see the change. I'm interested to see if more time is required for shit to figure itself out. It could be prior to 24. I mean, it's 2 months. Well, there's how I think Monday is going to be quite interesting. I'm not even going to say prior to 24. I'm going to say literally Monday. Like this shutdown, are they really going to let this shutdown go through? You know what that's going to do to markets in a situation where the bond market's doing what it's doing? Oh my God. It's absolutely wild. I mean, I was watching that hearing yesterday, and I'm just staring at all these geriatrics, and I don't mean that necessarily in the derogatory sense, but they're just old as fuck. And that's crazy, because I know old comes with experience, doesn't necessarily come with competence. An elected official is not necessarily competent. There was Tom Emmer, Mike Flood. Mike Flood was actually he actually did due diligence and brought a question and found information and presented it like an intelligent person. There was very few people that I was listening to that expressed, competence, a capacity to articulate, a capacity to express an idea, substantiate that idea with data and rationale. Everything else was just like, geriatric uh, bullshitting. Felt like I was sitting at a table with older folks in the family, or just like a table at the Real Housewives reunion or some shit. I don't know what the fuck they were talking about. Some of those geriatrics. That shit was crazy. Dan's in the house, Gelds, Hilda, Pleasure. Random question, but back in 2020, when you on the capital gains kick, looking back, what's something you would have done differently? Everything. And next time around, I will do things much better. There was way too much activity. Capital gains now going forward for myself is it's either going to be bloody frickin' obvious and the technical setup is there and it's just the time part of the equation, or it's not an option. My plan going forward with regard to that part of the portfolio, 1-2% bets from a capital gains perspective, is I'm going to wait for some really well-developed ascending triangles, and there will be 1, 2, or 3 in fiscal 24, fiscal 25, and we'll catch those nice gains. It'll be what it is. Maybe the measured move is 100% to the upside. You wait for the measured move, and you capitalize accordingly. I was nowhere near as comfortable as I am now back in 2020. I have no need to force a trade. That's probably the worst thing that anyone could ever do. You either have the conditions you're looking for presented to you, or you exit a position, or you get stopped out. If the story changes, you no longer stick with a position. So that's from a capital gains perspective. And we're not nearly in those conditions. So that means the odds are incredibly stacked against you in this kind of market. I don't see any favorable technicals. I'd be watching RT if you're looking for like scalping and trying to get entries, but I don't think there's room for any meaningful percentage rips to the upside from a PVP perspective. Not catching 100% rips back in 2020. I was ill-equipped and inexperienced as compared to now, and we were still catching 100%, 200% rips to the up. That was crazy. It was unstoppable. So could you imagine if you're actually prudent and actually waited for the technical setup that you want that makes it easy in an up-only environment? So that is the plan going forward. Extend, express extreme prudence. Look for the most favorable technical setup. Know that if it is invalidated, all right, you got to exit. The narrative changes. And that's where we'll be in 24 and 25. Hope that helps. So Sarko, yeah, Thursday stream. I didn't do one yesterday, and it's the end of the day here, so I'm trying to gather the energy required to get out the remainder of the words for this stream. On the 2020 cap gains question, I would have took more profits instead of thinking it would be up only. Well, the whole point of capital gains is it's not just knowing where to take profits. As you're looking at the technicals, for instance, if breadth, BREADTH, breadth to the upside is diminishing, the buyers are less and less, and you start to see the sellers uptick. So you look at the bids and the asks, you look at the volume. That's like perfect technical pattern for that is like an ascending wedge, a rising wedge, and that's where it falls out, and the rising wedge rolls over, and there's your exit, and then you're not getting back in. And when it finds a moving average, you're going to wait for a strongly expressed ascending triangle or a falling wedge for a reversal. In a bull market, a falling wedge and a reversal to the upside could carry a decent move. Clearly, in this market, a falling wedge and a break to the upside is basically going to go horizontal on you for 6 weeks. You don't get any significant action to the upside because the liquidity is draining. We can look on DeFi Llama and see that the liquidity continues to drain. So we'll have a very much improved perspective on how to engage in the market, how to engage the market from a capital gains perspective heading into 24 and 25. And for me, that's just not even a consideration considering current market conditions. Tapsy's in the house, DeFi Advisors in the house. This is the stream on a surprise Thursday. Yes, indeedy. Yes, indeedy. Ethereum with some nice action today, 3.88% to the upside, and an ETF approval. I hear 10% is going to be exposed tomorrow, maybe 50% on Monday. Listen, I think the futures ETFs are going to come quick. Maybe it is the case that Ethereum spot will be pushed faster than Bitcoin spot. I don't know why. You can only speculate and get into the heads of these regulators, and obviously it's pay for play to a degree. Obviously, there's a whole lot of backroom dealings, and it's not necessarily all like conspiratorial, but you can imagine the bullshit they talk about from a legal perspective, whether to move something forward or not. I don't even want to imagine. It's probably extra geriatric. So, but something's coming, and you could always say that, but with the yen looking the way it's looking, something's coming real soon. And with TLT doing what it has done with a 47.81% this morning, move to the downside, a breach of the 200 SMA on the monthly, something's coming real soon. Let's go out to the 6 month. I mean, that's from an ETF perspective. And bottom line is like the entire regime of the last 41 years is broken, and here's your trend line. And I drew this the other day, but you had a break to the upside. All right, so they're going to have to force vis-a-vis, not necessarily interventions, but regulatory massaging for the 200 SMA in the 6 month to be the top in yields, and the yields start to fall. Cycles will cycle. This will come down. The question is from where and what kind of intervention is required in order to maintain the continuity of the system. And the fun one is where does it come down to? And I would say it comes down to previous resistance, which would be around 2.33%. And that would be interesting because one, that's resistance flip support from a secular 41-year trend. Two, that would be a higher low on yields, and all of that would be completely deviant from what has been the norm for my entire life. I'm only 40 years old, and this has been the case since '84. And you could even argue that, top tier, topped in '81. So it's going to be new. I think the growth environment's dead. I don't see the continuation of what all these kids and did you see on crypto Twitter, like, oh, it's everything's going to go 10x and the equities are going to do ridiculous numbers. I don't see that as meaningful. I see companies are going to be on the defensive. They're going to be more protective of their balance sheet. There's going to be less interest in investing in companies. And how do you compensate for the general public having less interest in investing? You frickin' pay them. So this is a rising interest rate environment which changes the entire investment thesis of what it means to actually be something that is investable. For something to be investable, I've argued for a while as I've constructed the portfolio post 22. Fuck you, pay me. If you're not paying me, I don't consider it investable. And that's the type of returns I want on a position. And how do you measure what is a reasonable amount of returns relative to risk-free? If risk-free is paying 5 and change percent, I want 15%. I want more. Pay me 20%. If that's my goal and I can't get it, I think about decreasing the expectation. Maybe I shoot for a 15, but obviously you want to get paid more. So if a company that looks strong from a balance sheet perspective, strong from an adoption, consumption, volume perspective, how much business it's doing, and it's paying more, that hits both the check marks. And that's what I expect to occur, especially in crypto markets as compared to equities land. Equities land, you're at the whim, the subjectivity of the board for dilution. That dilute shares in order to raise capital. Oh, there's going to be a sale, a stock offering, not an IPO, but they're going to issue shares. Why? Because they need to raise capital. Why? To finance human resources, to finance OPEX, operating expenses. They need to finance, materials, supplies, so on and so forth, R&D. So you're going to get diluted. So this is not part of the equation when you choose particular assets in crypto markets, particularly ones that have deterministic policy. You call it monetary policy because the assets we look at have overtones of currency units, but it's akin to shares. And if you have deterministic contracts and token policy, it's equivalent to shares being deterministic. Now, when you have determinism, you could actually make choices and decisions with significantly reduced uncertainty. Uncertainty is what everyone's scrambling about. Are they going to intervene? When are they going to intervene? Are they going to drop rates? The subjectivity is something I want to eliminate from my everyday life because I find it infuriating that we're still dependent on subjectivity. I'm tired of humans. I want consistency. I want predictability. So that tomorrow I'm like, all right, this is what it's going to be tomorrow. It's easy to navigate. It's easy to make decisions. It's quantitative. And this is the story that Buffett will say from back in the day. Value investing. You look at a freaking balance sheet. They don't have a lot of debt. They're making money hand over fist. What's the price point of their stock? Is it cheap? Is it expensive? Relative to what? How much they're paying you. And to me, I love that. And to me, when I see the bond market doing what it's doing, and I see the interest rates potentially flipping port, I like the narrative of a return to the value investment regime, where it's not, oh, it's going to go up 10x on the money. I don't want it to go up 10x on the money. I want it to go up 2, 3x on the money over a 5-year period and pay me 25% like I'm a normal human being. I want to get paid for owning things, for making good decisions, for investing in solid companies, immutable, deterministic companies that I chose wisely because I saw the volume, I saw the product offering, the product market fit. And there's big products here. There's credit systems. Now, if you put the systems that we have primarily invested in, packaged in an enterprise, it's a bank, it's a credit system. And how many human resources, people are involved in those enterprises? How much real estate is involved in those enterprises? Oh, those salaries and benefits and all of the expenses. Get rid of it. You don't need it anymore. So, that's the whole efficiency argument. Now, these contracts, the concept of a contract doing lending, credit, collateralized debt positions, obviates the entire legacy banking construct. These are superior enterprise as compared to traditional banks. Get rid of all those operating expenses and replace them with predictable, deterministic behavior. I love that shit. That shit gets me all fired up. Patrick, good to see you, Cap. Your thoughts on macro setup and the strangely resilient labor market? Well, that shit rolls over real quick if if credit dries up. Like credit with the interest rates. Obviously, the federal government's crowding out the vast majority of credit. But what's the real credit that dries up? And I don't inspect it. But you probably could get the good numbers on it. But it's really like short-term loans from the banks to fund operating expenses, net 30, net 90. If all of a sudden, so that's why BTFP makes a big difference, because the banks now have a capacity to lend. They're able to get that capital directly from the BTFP to finance the credit that they issue that allows small, medium-sized businesses to continue operating. Net 30, net 90 is where a company is able to give the product to a consumer, and the consumer, being another company, Target, can pay the manufacturer in 30 days, and 90 days, and 120 days, because the manufacturer has that credit line. And that is the lifeblood of small to mid-sized businesses. The mega cap, the large cap, they have access to the bond market. They could issue bonds, and they have their stock to dilute and screw over their shareholders. So they have different ways to access capital. But small and medium-sized businesses aren't issuing bonds. They're not diluting their shareholders. The only way they get capital is from the regional banks. Net 30, net 90, credit, lines of credit, so on and so forth. So that's what the BTFP is supporting. So it's very much the case that we don't see a rollover in unemployment, or a spike in unemployment. And so there's a lot of things that indicate the smooth landing, the soft landing. That's the talking points of media. It drives me freaking nuts. More interested in fine, the not seeing a spike in unemployment, and the bond market rallies to 2.5%. That's the setup for next year, forward looking for a significant increase in liquidity conditions. The price of collateral doubles. And for you guys, you understand what happens if the price of collateral doubles and you have your collateral on Aave. All of a sudden, your health factor doubled. And what are you going to do when your health factor doubles? You're going to take out more credit. And when you apply that to the scale and scope of the planet, you're talking about liquidity flooding the system. And that's how you get your bull market. With that article, that post that Willie Woo talked about with regard to futures suppressing Bitcoin's historic price action is quite interesting. We could expect the same thing to occur with Ethereum futures, so it's quite likely the case that is consistent with what I'm talking about, not seeing the excess growth. We're not going to see the 10x's, the 20x's, the 30x's in anything. and especially Bitcoin and Ethereum in that regard, uh, unless spot comes online and neutralizes the future's suppressive effect. That could be interesting. But my base case is I would expect the entire expectation of 2010's growth to be disrupted. No more of those asymmetric moves and ridiculous malinvestment. I see more so a redistribution, a rebalancing of capital toward value. Companies that are actually meaningful, that actually make a society work and function, which means you'll get some significant price correction to the upside for what would traditionally be labeled a value investment. 2, 3, 4, 5, 10, 15x on the money, because they were undervalued for decades, and even the stuff in the crypto markets because they're just so small, considering the target addressable market, which is global permissionless credit. So they get repriced. So the value narrative in the first value cycle, speculatively, post secular trend breach right here that you're staring at, could be quite growthy, so to speak. And then if it's still producing 10, 15, 20% on the money, because there's no human resources, no real estate, then uh, everything of my expectations will be fulfilled, because that's my expectation. Um, Patrick, do you think additional contraction of money supply? If they continue to contract the money supply, I don't care about like M1, M2. I'm not looking at those money supplies. I'm more interested in the bond market because I understand when the amount of they issue and the amount they have to refinance next year, the Treasury market has been flooded with just excess paper, so to speak. If there's a rally in the long end, 2 years and up, um, that's collateral. And the collateral price is going up, and there's your Ave health factor just going through the roof, and there's your liquidity. So what you want to see for a bull market, as crypto Twitter persona would call it, is a rally in the bond market. And it doesn't have much to do with Fed policy, I don't necessarily think. I think that's more Treasury's wheelhouse right about now. Uh, Rates have been neutered, as argued by many macroeconomists, and I think that's why Treasury is going to start their buyback program in 24. It's just a buy pressure in the long end. And once the cycle flips, the amount of treasuries they've issued appreciating, what are they used for? What is the long end used for? It's used as collateral. That's the whole use case of the long end of the U.S. bond market. That collateral will appreciate, and I expect the next cycle where bonds rally is going to be a significant rush of liquidity through the system. How that compares to 2020? Well, there's going to be more collateral in the system as compared to 2020. So the pop off the bottom when bonds start rallying and the cycle rolls over should be pretty intense. There's much more collateral in the system. Therefore, there is a capacity for much more dollar liabilities to circulate through the system, as best expressed by the word liquidity. Good morning, gamers. Patty's in the house. Welcome. DeFi Advisor. Honestly, no offer is the best stream in the industry for self-thought process about investing. I just want to flip the whole thing on its head. I'm not going to do things the way anyone else does it. I'm going to do things the way I do it. And really what I've liked to do my entire life is to look at things differently. And this is about as opposite as you get. I'm looking at crypto markets as a value investor, thinking in the way Buffett would think. And obviously, I don't have the capital he has had over his career to execute hostile takeovers and push push companies around with just capital leverage. So it's not, I'm not comparable in that regard, but at least I could tell the story of how to engage with markets, just not the way the average crypto Twitter person would, with exuberance and that juvenile perspective. Oh, I'm going to buy something and it's going to go to the moon. We've talked about why things go up in price, why things go to the moon, and all the psychology involved in that process, and all the player versus player analogies that can be told, including ones that consider it from a biological perspective, predator and prey. And I just don't have any time for that shit anymore. I don't have any patience for that shit anymore. It's just it's just such mainstream, shallow, unsophisticated uh, bullshit that it just really, the systems are just so extraordinary that have been built in the crypto markets really demand a great deal of respect for how significant they are from a macroeconomic perspective. What they do, what they offer from a product standpoint to the global financial system is quite extraordinary. One thing I definitely is the cap on financial Twitter. Yeah, I look at financial Twitter, obviously the macro folks, but I check in with the dividend equities folks, and I think they're so far detached from anything realistic. Like I literally hear dividend folks on Twitter, on X, talking about oh the yield is up to 5%. Oh, I'm going to get it now because there's so much upside. It's, an equity, a yield bearing stock is offering 5%, and their price point is down 40% for the year. Oh, I'm going to buy it. I'm going to get the 5% yield, and there's so much upside. I'm going to catch a 100% rip on the upside. You're not going to get shit in equities land because they're going to dilute you. They're going to do some bullshit, and you're all dependent on the subjectivity of the board to manage their balance sheet. When you got things like Frax popping up pages where their entire balance sheet is displayed in real time, block by block on chain. How could I invest in equities when I have something like that? Real time, block by block balance sheet displayed. Oh my God. I can't deal with it. I can't deal with a lot of the equities folks. They're just literally missing everything about what's significant about this space. One thing I definitely know I should try to do more is try and get this gentleman as involved with us at Leviathan as much as he wants and is available to. I'm always happy to. I wake up every day and I got a lot of parental responsibilities and I work, and what you say is the case. You please try, and I'm more than happy to talk about anything as long as my time is available. You're flipping it on its head. No more time for kid shit for me. It's time where 24, 25, 26, heading into 2030, what do I want? The only way to get what I want is vis-a-vis crypto markets doing what I speculate they're going to do. Because I can't do this with equity markets in any regard. And what I want is to be able to walk to the computer once or twice a week, click a couple of buttons, and have enough capital, just like a paycheck. So how do I do that? How do I achieve that? By doing what we're doing. And I think it's gonna be exactly like that in 2028, 2029, 2030. I think that is going to be uh, my weekly routine. Click a couple of buttons. Oh, see you next week. We're going to Bermuda for the week. Dan, friend tech. Maybe, maybe I, I might want to consume it. I might want to. Uh, I'm not going to buy other folks from a speculative perspective. Maybe if there's good content, but that's not necessarily the case. I might I like producing content, so maybe the platform from that perspective could be interesting. Maybe I'll squeeze in some time and see if I could pay some attention to it. My favorite dev, which is the brightest young man I know, I'm pretty sure he learned about your streams from me. Proud of it. Told me you affected his thought process the most, only other than Buffett. Well, that's cool. I mean, my whole point of doing this is obviously my streams are a little bit selfish. I do this to help me understand what I need to do to achieve what I want to achieve. And by doing it in a transparent way, the selfish process of digesting these markets and figuring out the methodologies for understanding them and what they're doing, why they're doing it, and where things are heading, everyone else gets to see it as well. This is my little journal, my journey. So that's pretty cool. You're very welcome. It's a pleasure. How did I catch the live show, Yimity? Yeah, it's a Thursday at 4:50 in the afternoon. Go figure. Um, I should probably do a stream tomorrow. We'll see what happens. Maybe there'll be some news about the shutdown. I mean, that's crazy. They printed what? How much Treasury debt did they issue since the debt ceiling? And they still don't have enough capital to prevent the government from shutting down. You know, you could go on, and you could circle back around, and maybe I'll end on this point about like the Bitcoin narrative and being angry about the system and pointing at how bad it's broken. And I find it such a waste of time. I understand it's broken, and this is how I think it gets fixed. I think the biggest perversion, the biggest thing that's broken is the credit system. It's not necessarily the money. I think that is the easy thing to think causes all the problems our financial system has. Sure, it's pretty bad how Treasury just borrows and borrows and borrows. It's fucking shitty business. It's a business. They're borrowing money. I think the taxes are ridiculous. I think they should be much less, and the government should be much thinner and leaner and less social, and go back to more of the individual and that type of capitalistic history we have had in this country. Um, I think the Fed, with regard to their monetary policy, interest rates should be set by the general public based on supply and demand. And that makes the most sense, organic, such that, and the system needs to be designed to protect that organic reality against the manipulation and subjective interest. Needs to be organic, and that's what the damn crypto markets do. A contract that is immutable is going to behave exactly the same over and over again. So in that regard, Bitcoin does solve something meaningful. It was the first thing to solve deterministic monetary policy, deterministic as per what is accepted by consensus. That's extraordinary. So that's from like a Treasury with regard to their capacity to print, and in modern terms, the Fed with their capacity to print dollar liabilities. So that is a big thing to fix, but that doesn't fix almost anything, actually, particularly because if you replace the base money, you're still going to get the Bitcoin liabilities, and you're going to have the same exact system that you have now, except there's no way to uh, 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 deleverage the system. So the way what Treasury can always do is print dollars. And when they print dollars, those dollars already exist. They were already printed in dollar liability form, and those are the dollars that we use in the system. You could almost neglect all of the base dollars compared to the whole composition. The quantity of dollar liabilities in the system is just such a magnitude more than base dollars that if they print base dollars, M0, they're basically just deleveraging the system. So unfortunately, in that kind of regime, which is bound to emerge even from like Bitcoin as a base money type system, there's no way for Bitcoin to deleverage. So it might actually be worse if you think about it from that perspective. So my thought is that I think credit is the most important thing to fix part of global financials. Credit being subjective, where one party gets better terms and under collateralization gets perverted, that creates an artificial capacity for the system to increase the amount of currency in circulation. It needs to be more prudent, predictable, protective of the system, and that's exactly what these over collateralized systems have created. If it's over collateralized and it's going to sociopathically liquidate a position, if thresholds are breached, the system is protected. These protections don't exist in traditional finance because of the damn subjectivity, bankruptcy, and rolling over and special terms based on underwriting, and that's the perversion I think is most important to resolve in global financials. And that's what I think these smart contracts that predominantly from an EVM perspective have fixed. So sure, the Bitcoin narrative and fixing ensuring immutability of issuance is meaningful, but damn, the determinism of credit, I think that may fix a bigger problem. Hope that helps. Hope that helps. Friendtech. So DeFi Advisor mentions Friendtech. I will take a peek. Austin, let's go, Cab. Yeah, I get fired up. I try and talk about what's going on in current events, but every once in a while I digress into the way I see the system. And, like everyone, crypto Twitter will be obsessed with, oh, the price is going down. When is the Fed going to cut rates? No. Let's look at the fucking bond market and let's really understand why these systems are actually significant. And the interesting thing is when you talk about these systems from the perspective that I do, you're like, there's not really many systems that are significant. And most of the systems that have been created in the crypto markets are very redundant, and they redundant as in they do the same thing or they do something pretty remarkably similar. So when all is said and done, you probably have like a dozen or 2 dozen protocols that are truly significant to the crypto market and significant to such a degree that they offer meaningful products and services to the real economy. When I say the crypto market, I'm implying the financial economy. But the financial economy obviously caters to the real economy. And there's these few, dozen or two systems offer significant improvement to status quo systems in legacy finance. Fix, what do they say? Fix the money, fix the world. That's what the Bitcoin narrative maximalists say. I say fix credit, fix the world. And fix credit requires a story of why credit's broken, and it's broken because of humans. And frankly, money's also broken because of humans, but I think credit is probably the biggest problem with the world. Hope that helps everyone. 30 people made it to the end of the stream. Holy, whoa. Thank you all for joining. 6 likes, smack that thumbs up button, subscribe, tell everyone to stop by and say hi. If everyone's noticed, I answer every question, so you could literally get like a basic intro to crypto, or you could get a sophisticated perspective on these systems just by asking questions. So I appreciate all of you. Thursday, September 28th, 5:01 p.m. In the description is the link to the most rational community in the entire crypto space. I appreciate everyone in there. I'll see you tomorrow. So enjoy your night. Catch you on the flip side. Peace.